Stock market update part 2. Okay, where are we on the S&P 500? Now, if we look at the monthly MACD, whilst that is still very much on an upward trend, and I remain positive for the year, the weekly is now looking like it's losing some steam, which is more sensitive to immediate market movements and gives us a clue of short-term movement. And I suspect we're going to get something like this. I suspect we're going to get, if you ask me right now, April 14th, I think we're going to get maybe a 10% drop, 10 to 11% on the S&P, and then we will move up, which is when the monthly MACD kicks in. I think we'll get a repeat of this. I might be wrong. It might just continue going up. It might just touch that, bounce up, and keep going up. So we'll keep looking. But at the moment, there's no action for me to take, and I'm relaxed about the market, because even if it drops 11%, I'm looking for it to basically have gone up, dipped, and then risen. Now, why am I not trading that well? Trading is a completely different thing I do with futures and CFDs. I don't trade my investments. The FTSE 100 should continue going up, but remember, it rather like an asthmatic child, it will probably run out of steam at some point, and won't be able to continue. Nothing against asthmatic children, I used to be one. The NASDAQ has got a little bit more room up there. What I want you to be mindful of is what I call drawdown danger. What's drawdown danger? Well, drawdown danger is how much it might fall. That's the depth. It could easily fall in an upward trend. That's an upward trend. And so that's the depth, and that's the duration. So remember, drawdown danger, the way to remember this is DDD equals depth plus or times duration. Okay, so don't be shocked if the duration is a couple of months and the depth is whatever that is in percentage terms. You can work that out in your own time. So that's why I stay calm during periods of volatility, a bit like a pilot going through navigation. He doesn't call going through turbulence. He doesn't call Mayday every time if he knows short-term and long-term difference. Perspective gives us resilience in investing as well as in life. Now, Apple, hopefully the weekly has sort of stabilized a bit. We might get a bit of updraft. But yeah, it seems to be forming this nice little base. Doesn't mean it's not going to drop, but I've still got my 50% holding in Apple. 50% I sold a couple of weeks ago just because the monthly had fallen below its moving average, which, as I say, when it tends to do that, I don't want to have a full holding. So that's your Apple. This is for the Great Investments Program people only. Microsoft, where are we on Microsoft? I continue holding it, but because it's so elevated, I don't think I'd buy more, and certainly wouldn't do double leverage now as a new position, but my existing ones and my son's 2 times leverage Microsoft ETFs are intact, and they've made him, I don't know what that is, 100+% since January of last year. So we continue holding those, mindful that at any moment could easily get a 10% drop, and it might be time to ease out of them. Okay, so watch for the next broadcast on Wednesday and you'll get the update. Amazon, Great Investments Program only. You can find out more about that on alpeshpatel.com/links, and they do portfolio reviews. You can get a tour of it as well. Disney, fine. That's going up, that's going up. Remember, if the weekly and the monthly MACDs are rising, then that's the point at which you're most likely to get some of the biggest moves up. Not guaranteed, but you're likely in any stock to get the biggest rallies. And you might say, well, why didn't you only ever pick ones which are like that? Well, few and far between. Now, I'm going to show you some stocks which I've not finalized. I've not finalized for my clients. So these are not the final editions, but they're ones on my watch list to research more and then decide whether or not I give them as special situations for clients. So do not pile into these thinking that they're finalized. Hannon Armstrong is one. Levi Strauss is one that I actually own and like. Okay, these are not individual stock advice though. Alliance Bernstein is one yet to be finalized as a special situation for my clients. Hilton Food also to be finalized for my clients. CNC on the UK side, looking relatively attractive. Ken Holmes as well. Don't forget, on YouTube you're going to find Sally and I a lot. but you're also going to find my views from not just on the BBC, but other places on why fund managers and IFAs probably need to be locked up. Now, Nvidia, very similar to Meta, of course, it's overbought. I wouldn't buy more at the moment. I continue holding what I've had since here. Sadly, I never had 2 times leverage in this. It would have been too volatile, too risky for my appetite. But even on the one time, myself, my son and my wife's junior ISAs, my son's junior ISA and my wife's SIP, she's not eligible for a junior ISA, would have been still rocking ahead. But if that drops X, I'd be exiting 100%. Now, what is X? Well, if it drops 25%, I'd exit 100%. But if it drops 10%, if you're risk averse, you might exit 10%, 20%, 30%. You just make those numbers based on your risk appetite, and that way you've got a strategy and a plan on exiting. Now, why didn't we get out here? Well, I was worried then, but it kept rising. It just wouldn't fall X. It wouldn't fall that 25%. So there was no reason to, and it kept giving. But on the whole, usually when that's quite high relative to where it's been before, it is time to exit, but I don't exit prematurely, which is a mistake a lot of private investors make, because they don't have the, if it drops X, sell Y strategy. They just, even if it doesn't drop X, they just sell, which is weird. Tesla, it's a bellwether. It's not one I own. We exited back then after that fall in October and reinforced that decision because the monthly MACD was falling. So we're out of that, and there's, I don't know, it might be forming a base, but it's not a special situation at the moment. It's a popular company, that's why I put it in the weekly updates. Meta is for Great Investments Program only. NXP, I continue holding. It's approaching sort of the top of this pile. So by now, would I say you've missed the boat by now? Well, it's a tough decision. I don't really need to answer because we got in last year, so there's no need to answer it today. Qualcomm still looking good for us as well, rising momentum. And of course, don't forget, with all of these, we looked at the fundamentals: value, growth, income, Sortino, alpha. So we look at the fundamentals of the accounts, we look at the statistics of the share price movements, and we look at the price charts as well. So it's 360-degree view. ServiceNow, Great Investments Program only. Now, Intel's really let me down. Last year was great, but this year, of course, it's fallen off a bit of a cliff, and time to exit that one anyway. Netflix, not one I own. It's one we've covered after it had those rises. It was to show you that even after big moves up, all of this, to determine whether or not you've missed the boat, you'd really look at the monthly momentum, but you'd also look at value, growth, income, cash flow. Don't just look at charts. Don't just look at fundamentals. You really need to look at both. Otherwise, you're leaving a lot of important information on the table. But you can't just look at the charts, because, look, that's a good example of why you can't just look at the charts. You've got to look at fundamentals at the same time. As I said, lots of videos on individual pension funds and why they do so poorly. That's now 1.3 million views. TikTok, that's now 330,000 followers with well over 1.2 million likes as well. So do have a look at that. And as I say, on YouTube, alpeshpatel.com/links, you'll find a lot of information about my analysis of pensions and why they've done poorly. I've written 18 books on investing, which is one of the reasons why I guess I'm a top voice on LinkedIn. I don't say that just to brag. Somebody said, oh, we're always bragging. Actually, because on the internet, you've got to establish your credentials. Some say expertise and credentials don't matter. Well, fair enough. Then ignore the credentials part. If you are interested in the Great Investments Program, don't. These are the problems with fund managers. That's the problem with IFAs. That's the problem with those robo-advisor apps. You can have a look at this. And the closest person to being able to tick all the boxes is you, is the DIY investor. You're a lot better than the fund manager, who've got a lot of handicaps, which is why they don't tend to outperform indices, because they've got to hold stocks even when the market's falling. They can't do the obvious thing you and I could do, which is just step aside and hold cash and calibrate. And equally, because they put so much money in so many companies, if they do happen by accident to pick a good company, it'll barely budge the portfolio, because they put so much money spread across so many companies. So they've put so little money in each individual one, if you see what I mean. Have a look at alpeshpatelreviews.com if you want to see videos and interviews with some of the clients and how happy they are as well. And campaignfor1million.com, my campaign to teach 1 million people globally how to add an extra million to their portfolios and their pensions across their lifetimes. 1 million times 1 million is 1 trillion. That's a pretty good ambition to have. Thank you very much. Speak to you soon.